So for those that aren't familiar with the fund, I think it's important to recognise that this is not 2-minute rice. The original Chindia Equity Fund concept was first conceived all the way back in 2002, and we launched the fund officially in December of 2006. The rationale was very simple: to map the regional equity skill set we have here at Ashburton. We've been successfully investing in Asia for several decades now, against our long-term vision of the future. China and India, the combination of those countries for us, provide investors, both existing and potential, with the best long-term investment opportunity in an emerging markets context. So we continue to believe that a case for a single coherent emerging markets class has never been weaker, given the wide divergence that exists between each country's economic, social and political structure. If we think at a high level about the emerging markets basket, we can categorise that emerging markets into 3 distinct categories. We have commodity exporters, including the likes of South Africa, that are facing deteriorating terms of trade and a great deal of economic and political volatility. We then have global traders, that's the likes of South Korea and Taiwan. They are essentially high beta growth proxies, which puts a huge emphasis on the fund manager getting the timing of the market cycle right. And finally, there's China and India that offer high level growth, a strong and decisive government, certainly in a relative context, good structural underlying consumption stories, and a reform mandate. And that combination for us offers investors a very, very long investment runway. So taken as a whole, we firmly believe that an emerging markets aggregate basket actually brings a weaker risk-adjusted return profile to the overall portfolio rather than genuine diversification. That blend of China and India offers investors access to a large, liquid but focused emerging markets proxy. So our philosophy and approach to both markets has been refined and developed over several years now. That is a function of our own investment experience, the equity market landscape in both countries, and the entrepreneurial culture embedded at First Round, our parent company. India's incredible market depth, strong national equity culture, and arguably the best corporate management in Asia enables the portfolio managers to take a very fundamental approach to investing there. So a macroeconomic top-down view is blended with industry trends to drive the major investable themes. Once those themes are identified, we utilise a combination of internal proprietary and external research to better understand the market dynamic. From that point, the investors travel regularly to the country to both foster our market knowledge and meet with existing companies that we own within the portfolio, or to identify future opportunities. Quality plays a huge part in that filtering process. It's a key cornerstone, and by quality the portfolio managers place a very strong emphasis on management integrity, strong corporate governance and a long track record of execution and delivery. Turning to China, despite the country's vast economic size and impact on global trade, the capital markets there are very much emerging in a transitional economy. Consequently, the blueprint that we apply in India just isn't transferable as we stand here today. So the portfolio managers adopt a purely quantitative approach to China. We have 2 models, both proprietary and systematic, that govern the entire investment process. The market timing model seeks to gauge the underlying health of the market at an aggregate level. That determines the country allocation in China. Once that is determined, a multi-factor screening model drives the stock selection process. Portfolio construction as a result of these 2 processes is a high conviction equity mandate of 20 to 30 holdings in each market for a total of 40 to 60 Chindia Equity Fund holdings. So for us, the China and India proposition remains a deeply compelling one. Going forward, growth in both countries is going to be driven by a much more sustainable balance of consumption and investment, with each country benefiting from the growth driver it needs most. China through consumption, India through investment. These underlying structural tailwinds, combined with that strong and decisive government, President Xi in China, Prime Minister Modi in India are arguably the strongest leaders that either country has seen for the past several decades. That, combined with the reform agenda and the political will to enact on those reform agendas, will lead to unlock tremendous economic value going forward. For Ashburton and our investors, that creates tremendous long-term investment opportunities.